Okay, this is the first video for Chapter 2. In Chapter 2 we're going to be building on what we learned in Chapter 1. So we're going to start with our accounting equation. And in accounting, or in the first chapter, we talked about the accounting equation of assets equals liabilities plus owner's equity as the accounting equation. In Chapter 2 what we're going to be doing is expanding and looking at maybe let's call it the accounting process. The process of how we recognize, analyze transactions, how we identify them, how we record them, and how we report them. Remember before when we were talking about what accounting is, and it's an information system for identifying, recording, and reporting the relevant business activities of an organization or enterprise. So we're going to be teasing that out a little bit. And so we have assets, liabilities, owner's equity is the accounting equation. Assets. Let's do all these in a different color. Assets. What are assets? We talked about assets are. Let's talk about different kinds of assets. Because we talked about assets as are the resources that a company owns or has control over. They're going to get future benefits from those resources. An obvious asset would be something like cash. Cash is an asset. They have a bank account. First National Bank of Traverse City, or pick your bank of preference. You have a cash account, and you have maybe multiple cash accounts, or even multiple banking accounts, different banks. Cash, petty cash, different kinds of cash accounts, all of that is considered cash. You also have things like accounts receivable. Accounts receivable. What is an accounts receivable? If I'm in the sneaker selling business and I sell you, let's say I'm the manufacturer and I sell them to you, and you take them and you sell them to other people. When you buy those sneakers from me, you buy them from me on credit. So I say, it's kind of like, I don't know if you remember Popeye or not, but I'd gladly give you a hamburger tomorrow, or I'd gladly pay you tomorrow for a hamburger today. You'd say, I'd gladly pay you, next month if you give me some sneakers today. That's accounts receivable. On my books, that's an asset. It basically says, I have an account receivable. I'm going to receive from you money, because we've already exchanged the goods. I've already given you the sneakers, and you've walked away. And I'm saying, okay, will you pay me in 30 days? And you say yes. Those are considered accounts receivable, trade receivable. There's also things like notes receivable, which are more formalized than accounts receivable. Notes receivable would be a promissory note. I have an actual legal document that says, hey, you agree to pay a certain amount of money to me at a certain period of time, or on a certain date. And so that would be an example of a note receivable. There's a lot of different assets, and we're not going to cover them all. But another example of an asset would be, the book talks about prepaid assets. Now these can be a little tricky. What is a prepaid asset? Prepaid asset, an example of that would be like insurance. If you pay, let's say you have $1,200 a year in insurance, and in January you pay $1,200 for the entire year. Well, we want to make sure that we spread that $1,200 out over an entire year. So it would be $1,200. It'd be $1,200, right? Divided by 12 months. So it would be $100 a month. So we would record the $1,200 that we paid in January as a prepaid asset. We paid it today with the idea of getting future benefits over the next 12 months. So prepaid insurance would be an example of that. Prepaid rent could be another example of that, where we pay in advance. We pay rent for a period of time. Let's say we pay rent twice a year. We pay in January, that covers 6 months, and we pay in July for the last 6 months. That would be something that would be showed up on the balance sheet as a prepaid asset for now. We're also going to see things like, we're going to get into inventory, property, plant, and equipment. These are all different assets. Now let's go to liabilities, because assets equal liabilities plus owner's equity. What are liabilities? Liabilities are claims against those assets. Where did those assets come from? Well, we either borrowed from a bank or from somebody else, a creditor we borrowed, or it's coming from, I'm going to use a different color when I talk about owner's equity, or it's coming from something we put into the company as owners of the company. Well, examples of liabilities would be accounts payable. Accounts payable. These are accounts receivable, something somebody owes us. Accounts payable are something We owe somebody else. In this case, someone has given us the sneakers, and we agree to pay them at a later date. So that's a liability for us. We owe them the money for the sneakers that they have given us. So those are considered accounts payable. Other things to be notes payable would be another example, notes payable. It's the opposite side of a note receivable. If we have a payable, a note, somebody has given us money and we agree to pay them in 6 months, that would be an example of a note payable. Any kind of bonds, long-term debt. Long-term debt. These are all debt obligations. Another example of a liability, it's kind of tricky in the sense that prepaid is tricky, is unearned income. Unearned income. Unearned income would be, say we have a magazine, or Time, and we sell subscriptions to various sorts of magazines. And let's say you pay in advance. You say to us, hey, I want to buy your magazine, and we're going to make the math easy. I'm going to pay you $120 today, and you owe me the magazine for 12 months. So 120 divided by 12 is $10 per month. When you pay us that $120, that is a liability. It's unearned income. We owe you now $120 worth of services that are going to get spread over a 12-month period. That would be an example of unearned income. And we're going to see this later on as we revisit all these things. I'm just trying to show you what these different accounts are under these various classifications in the balance sheet. Assets equals liabilities plus owner's equity. And owner's equity is the most straightforward. Owner's equity is money that the owner has put into the company, so it's capital that the owner has put into a company. Any withdrawals come out of that. Net income. Remember we talked about net income coming in. In fact, let's do that over here. Let's have our sales minus expenses equals net income. And we know that net income, that number in net income over here, comes over and impacts owner's equity. So net income right there. Net income right there. Or net loss if it's a loss deduction. If you're a corporation, you have stock. Things like additional paid-in capital. We'll talk about all this at a later date, but those are some examples of accounts. And that's what I want us to see. Under sales, we're going to have accounts. We're going to have revenue accounts. And we may have different revenue accounts. Say we sell sneakers, right? We may have a separate account for sneaker revenue. Sneaker revenue. What if we also sell accessories? We sell shoelaces. So we may want to track that. Shoelaces. Or we want to track, you know, those little balls that smell, deodorant balls for sneakers? We may have deodorant balls. A little crazy, but we may have different revenue accounts. And expenses, we're going to have operating expenses. We're going to have things like wages, right? We're going to have utilities, which might be broken down into gas, electric, things like that. We're going to have rent. We're going to have all these different operating expenses to operate the business. And we take all these revenues less expenses. That gives us that net income figure, which comes over to here. But what we're seeing in Chapter 2 is, and what I want to point out here is not just, I want to take the accounting equation, assets equals liabilities plus owner's equity, but show it and that each one of these is an account. An account. They are accounts. So what is an account? An account is a record. That's all it is. An account is a record of increases and decreases in specific asset, liability, owner's equity, revenue, and expense accounts. Each one of these is an account, an example of an account. It's a record of increase and decrease in a specific asset or liability, owner's equity, account, or revenue and expense accounts. Each one of those are accounts. So it's a place to record things. It's a record. That's what an account is. When you add up all those accounts, if you summarize all the accounts, that's equal to what? That's equal to a ledger. It's called a ledger or a general ledger. So we'll look at this further, but I just wanted in this video show what accounts are and show that the summary of the accounts is something that's called the general ledger. This is accounting lingo. We have to get familiar with some of the terminology, not just the process of accounting, which I'm going to look at in just a second, a little more detail, but the understanding of the process, but also understanding the language, the lingo that goes along with it. So that's it for this video. See you in the next one.